Hello, everyone. This is the second clip of Chapter 1, Accounting in Action. In this clip, we will look at the learning objective number 4 and 5. So we will analyze the effects of business transactions on the accounting equation. And we will also describe the 4 financial statements and how they are prepared. Now let's look at the first one, okay? So when analyzing the business transactions, we're going to look at the economic events of the companies. So transactions means the business economic events recorded by accountants. It may be external or internal. For example, if the company paid their employees the salary, it will be internal transaction. Okay, if the company buy inventories from the suppliers, so it will be external transaction. All right. So there are a lot of activities in the business, but remember that not all activities represent transactions. So you remember the first step of the accounting, we need to identify, okay, which economic events or which activity should be a transaction. And remember that every transaction will have a dual effect on the accounting equation, okay? Dual effect, it means if, for example, if it increase assets, okay? So it can increase, liability or owner equity. Or if it decrease assets, it will have another effect on liabilities and owner equity. Or it can increase assets and decrease assets at the same time. So every transaction will have a dual effect on the accounting equation. Now, these are the steps that the accountants need to do. First of all, they're going to analyze the business transactions. Then they're going to journalize it. Journalize is mean you're going to record it, okay? Record the transaction. And then you pause it to the lectures. We're going to learn it in chapter 2. And then we prepare the trial balance. After that, we prepare the adjusting entries. We're going to learn about the adjusting entry in chapter 3. And after adjusting entries, we're going to prepare adjusted trial balance, okay? And then after adjusted trial balance, we're going to prepare the financial statement, okay? And then finally, the accountants will prepare the closing entries and then the post-closing trial balance, all right? Now, so for example, if I have some events like this, which one should be a business transaction that we need to record, okay? So let's look at the 3 events here. So first is the purchase computer, okay? Is it, the criterion is the financial position, assets, liability, or owner equity of the company change? So if we buy a computer, does it make our assets, liabilities, or owner equity change? Yes, right? Because we're going to have an assets, right? Okay. And if we buy it, we owe money, then our liabilities will also increase. So do we need to record it? The answer will be yes. Okay, we need to record it because it affects our assets and liabilities. Sometimes if we buy, the computer by paying cash, so it will only affect the assets. Okay, it will increase the equipment, and if we pay cash, it will decrease the cash. So it's increase assets and decrease assets at the same time. Okay. Next, discuss the product design with potential customer. Is it an economic event? No, we just discussed, the company just discussed the product design with potential customer. So does it influence our assets, liability, or owner equity? The answer is no, because we just discussed the design. We don't do anything related to our assets, liability, or owner equity. And next, pay the rent. Okay, so is it influence our assets, liability, or owner equity when we pay for the rent? Yes. Okay, because our cash will decrease when we pay for the rent, and we have a rent expense. Okay, rent expense. So yes, we should record that transaction. So the first step in accounting is that we need to identify all the business activities, which one that we should record it. Okay, which one that we should record it. Now, let's look at the transaction analysis. So we're going to do the tabular analysis. This is called a tabular analysis. So on the left side, you will see assets, okay, assets. And on the right side, you will see liability and owner's equity. Under assets, we have cash. Okay, we have cash, and we have account receivable, supplies, and equipment. Okay, under liabilities, we have accounts payable. Under owner's equity, we have owner's capital. You remember we learned about owner's equity in the last class? Owner equity is influenced by owner's capital. Okay, our investment to the business, it will decrease by drawings when the owner withdraw the money. It will increase by revenue, and it will decrease by expense. Okay, so let's look at this one. Transaction 1. Ray Neal decides to start a smartphone development company, which he names SoftBite. On September 1, 2020, he invests 15,000 cash in the business. This transaction results in an equal increase in assets and owner's equity. Okay, so you see here, Ray Neal, he invests money, 15,000 cash, okay, in this business. So when the owners invest the money in the business, our cash will increase, okay, and cash is an asset. Did you see that? So my cash increased by 15,000, all right? Now, when he invests in the business, right, so he own, his ownership also increased by 15,000. Or we say that owner's capital increased by 15,000. So did you see that? The equation is equal now. Okay, assets equal to liabilities plus owner equity. The left side should be equal to the right side. Okay, let's go to the next one. Transaction 2, SoftBite purchased computer equipment for 7,000 cash. Okay, so when we buy computer equipment, okay, our equipment will increase. our equipment will increase. Okay, so I add 7,000 in equipment, and because we pay by cash, right? We pay money. So when we pay money, our cash decrease. Okay, so it will decrease by 7,000. So cash will have minus 7,000 here. Okay, because we pay cash. So did you see that if this transaction is increase assets and also decrease assets, right? Remember, every transaction will have a dual effect. Okay, dual effect. Number 3, sort by company purchases for 1,600 assets and other accessories expected to last several months. The supplier allows sort by to pay this bill in October. Okay, so what happened now? So our supplies will increase by 1,600. Okay, headset and accessory are assumed as supplies because they are used in the business. And account payable increased by 1,600. Why account payable increase? Is because the company say they will pay the bill in October, right? So now they haven't paid anything yet. Okay, it say that it will pay this in October. So this means now we haven't paid money yet. So we owe the money and we're going to pay it in the future. So in this case, we have an account payable, or we say that account payable increased by 1,600. Okay, now let's go to the next one. Okay, sort by received 1,200 cash from a customer for apps development services. It has performed. Okay, it has performed. So if you can see here, the company received the money from the customer. Okay, so when we receive the money from the customer, our cash increased by 1,200, and service revenue also increased by 1,200. Okay, service revenues increased by 1,200. So whenever we perform any service to the customer, okay, then we earn a revenue. If you already finished performing the service to the customer, then the company will earn service revenue, even though sometimes they haven't received the money yet, okay? So in this case, we have service revenue or revenue increased by 1,200 and cash also increased by 1,200. Okay, next is transaction number 5. Sort by company received a bill for 250 from the Daily News for advertising on its online website, but postpones the payments until a later date. Okay, so what does it mean? This company, they received a bill from Daily News, okay, a Daily News. And how much is the bill? $250 or 50 euro, okay? So what happened here? It received a bill, you know, from another company, say, please pay me $250 because I help you to advertise, okay, on an online website, but postpone the payment until a later day. So it means that it received a bill from other companies, say, you know, they have performed the service for us. And so they asked us to pay the money, but the company did not pay the money yet. Okay, it postpones the payment until later day. So in this case, what happened? We will, what do? The $250, it will increase the expense by $250 and account payable by $250. Okay, we call it advertising expense. Now, advertising expense increase, yeah, increase by $250, all right? Advertising expense, again, increase by $250. Advertising expense increase. Increase by $250. But when advertising expense increase, what happened to owner equity? What happened to owner equity? Owner equity will decrease. Okay, owner equity will decrease when advertising expense increase. Okay, so owner equity decrease. So it is the minus sign here. Okay, the minus sign here doesn't mean that advertising expense decrease. Okay, advertising expense actually increase, but when advertising expense increase, owner equity decrease. So we have a minus sign here. All right. So liability increased by $250, advertising expense increased by $250. But when advertising expense increase, owner equity will decrease. So there will be a minus sign there. All right. Okay, let's go to the next one, which is transaction number 6. Okay, SoftBuy performs 3,500 of services. The company received cash of $1,500 from customers, and it billed the balance of $2,000 on account. Okay, so what does it mean? The company already performed the service, all right, to their customer. The service is around 3,500 euros, all right? Did the company receive all the 3,500 euros? No, it's only received 1,500 euro cash from their customer. It's only received this much. Okay, what about the remaining? Okay, remaining is say it bills the balance of 2,000 on account. So when you see the word on account here, it means that they don't receive the money yet. Okay, they bill another company 2,000 on account. So it means that we're going to receive 2,000 euro in the future. And we only receive 1,500 for now. All right. So what will be the journal entry? So we're going to we're going to have an increase in cash 1,500 because we receive money 1,500, and we have an increase in account receivable 2,000. Okay, account receivable increase by 2,000 because we're going to receive that 2,000 in the future. Okay, remember account receivable. Account receivable means the money that we're going to receive in the future. All right, so we're going to receive 2,000 in the future. So cash increased by 1,500. Account receivable also is increased by 2,000, and service revenue increased by 3,500. Why service revenue increased by 3,500? It's because the company already performed the service. Okay, and remember what I said just now, when the company, perform the service, okay, what happened? Then service revenues will increase, okay, whenever the company perform the service. When we perform the service, then we have an increase in service revenue, all right? Okay, all right, so let's go to the next one, okay, the next one, which is transaction number 7. Sort by pays the following expenses in cash for September: office rent 600, salary and wages of employees 900, and utility 200. Okay, so what happened here? We have expenses, right? We have expenses. We have 3 types of expenses here. Okay, now you need to separate all the expenses. Don't include them in one. Okay, so we have 3 types of expenses here: office rent expense, salary and wages expense, and utility expense. Okay, office rent is being the expense that happened when we use the office, when we rent the office. Salary and wages expense means when the employees work for us, then we have to pay them salaries. And utility expense, this is for electricity, this is for electricity, water, telephone. In the company, we call it utility expense. Okay, utility expense. It means electricity, water, and telephone. Okay, now, so how do we do this? We're going to separate them into 3. Okay, so the company pay 600, 900, and 200. Okay, so my cash will decrease by 600. Rent expense will increase, okay, by 600. But when rent expense increase by 600, what happened to owner equity? Owner equity will decrease. So we have a minus sign before 600 here. All right, next, cash will decrease by 900, and salary and wage expense will also increase by 900. But when salary and wages expense increase, owner equity will decrease. Okay, so we have minus sign beside the 900, in front of the 900. And then we pay for the utilities 200. So cash will decrease by 200 and utility expense increase by 200. When utility expense increase, we will have a minus sign in front of 200. Okay. All right, let's go to the next one. Transaction 9. Okay. Transaction 8. Sort by pay is 250 daily news bill in cash. The company previously in transaction 5 recorded the bill as an increase in account, payable. Okay, so what happened here is that, you remember transaction number 5? Okay, look at transaction number 5. All right, transaction number 5 is happened when the company, owe money to daily bill. Okay, it owe money of 250, and then we have an advertising expense of 250. All right, now in this transaction A, now we're going to pay for the money that we owe them. Okay, So we don't record the expense again because we already record expense in transaction number 5. All right. So now when we pay for the liability, what happened is our cash will decrease by 250 and the liability will decrease by 250. It means that we don't owe them the money anymore. So our account payable will decrease, okay? Will decrease after we pay them the money, all right? Okay, so let's go to the next one. It says transaction number 9. Transaction number 9 say SoftBite receives 600 in cash from customer who had been billed for services in transaction 6. Okay, so do you remember transaction number 6? Transaction number 6, we have 2,000, dollars on account receivable that we bill the customer. You remember that? Okay, so in transaction number 6, okay, we perform a service to the customer and then we receive only 2,000 cash and 1,500 cash, and the 2,000 is the amount that the customer owes us, or the amount that we're going to receive from the customer in the future. And now in transaction number 9, it says the company receives 600 euros in cash from the customer. So now our cash will increase by 600 and our account receivable will decrease by 600. Why our account receivable decreased by 600? It's because the customer owed us last time 2,000, right? And now they pay back to us, okay, 600. So that means that our account receivable should be decreased by 600 because they don't owe us 2,000 anymore, okay? Or in other words, we will expect to receive 1,400 more after we got 600 here, okay? So in this transaction, cash will increase by 600 and account receivable will decrease by 600, okay? Because the customer already paid us. Now let's look at transaction number 10. Rainier withdraws 1,300 in cash from the business for his personal use. So when the owner withdraw the money, okay, so cash will decrease by 1,300 and drawing, okay, drawing will increase by 1,300. Okay, this is drawings account, owner drawing. Okay, this is increase. It is increased by 1,300. All right. When owner drawing increase, what happened to owner equity? Owner equity will decrease. So when owner equity decrease, we're going to have the minus sign there. Okay. So you will see the minus sign here. All right. This is the minus sign here. So again, in this transaction, owner drawing increased by 1,300. When owner drawing increase, we have a decrease in owner equity. So we have a minus sign here. Okay, and cash decreased by 1,300 because the owner withdraw the money from the business. So our cash will decrease. Okay, let's go to the last one. We need to total all the column for me. Okay, so when you total all the columns, you're going to add everything together. Okay, add everything together. And then you will see that the total of the left side will be equal to the total of the right side. Okay, so assets equal liability plus owner equity. It should always be equal. If you didn't get it equal, it means that something is wrong. So in summary, every transaction analyzed in terms of effect on assets, liability, and owner's equity on the three components of the basic accounting equation. And specific types of items such as cash. And remember for me that the two sides of equation must always be equal. Okay, let's try with this example, tabular analysis. Transaction made by Vermeer SA, a public accounting firm, for the month of August are shown below. Prepare tabular analysis which shows the effects of this transaction on the expanded accounting equation, similar to that shown in illustration 1.8. Okay, the owner invested 25,000 cash in the business. The company purchased 7,000 of office equipment on credit. The company received 8,000 cash in exchange for services performed, and the company paid 850 for this month's rent. The owner withdrew 1,000 cash for personal use. All right, how do we do this? Let's look at the first transaction. The owner invested 25,000 euro cash in the business. So in this case, cash will increase by 25,000. Okay, cash will increase by 25,000, and owner's capital will increase by 25,000. Okay, cash increase by 25,000 and owner capital will increase by 25,000. Because you know, owner capital is the investment of the owner or the ownership. So when the owner invests money in the company, owner's capital will increase. Okay. Next, transaction number 2. The company purchased 7,000 of office equipment on credit. Now, when you see the words on credit or on account, it means that the company didn't pay by cash. Okay, they owe money. All right, they owe money. So they buy 7,000 of office equipment. So what will increase? Our office equipment will increase, right? So what do we have? Our equipment increased by 7,000. Account payable increase. Why account payable increase? Because we buy on credit, on account. It means that we owe them the money, 7,000. Company buy equipment, but they don't pay, but they don't pay the money yet. Okay, they owe the money to another company, 7,000. So our account payable will increase by 7,000. Transaction number 3. Okay, transaction number 3. The company received 8,000 cash in exchange for services performed. Okay, so the company received what? 8,000 cash. The company received 8,000 cash in exchange for services performed. It means they already perform a service and then they receive 28,000 cash. Okay, so what do we have here? We will have cash, increased by 8,000, and service revenue increased by 8,000. Why service revenue increased? Because the company already performed the service. So as I said before, whenever we finish performing the service, what happened? Whenever we perform the service finish, what happened? Our service revenue will increase, okay? Even though we haven't received the money yet, okay? So whenever we perform the service, our service revenue will increase. Okay, let's go to the next one. Transaction number 4. Okay. Transaction number 4 say, the company pay 850 for this month rent. Okay, so we pay money. So cash will decrease by 850. And expense, we have expense is the rent expense, right? Rent expense will increase by 850. But remember, when rent expense increase, what happened? Owner equity decrease. So we have a minus sign in front. Okay. Next, number 5, transaction number 5, the owner withdrew 1,000 cash for personal use. Okay. So when the owner withdrew 1,000 cash for personal use, what happened? Our cash decreased by 1,000 and drawing will also increase by 1,000. But when owner's drawing increase, what happened? Owner equity decrease. So we have a minus sign in front. Okay. Now we're going to total all of them. We sum all of them. Okay. All the column. And so we will get total assets is 28,150, and total liability in owner equity will be 28,150. So at the end of the month, how much cash that the company still have left? It will be 31,150. Okay. How much money do they owe? 7,000. Okay, account payable. All right. How much money that the company, withdraw? It will be 1,000. All right. So when you add all of this, you will see the net amount for each account at the end of the month. Now let's go to the financial statement, the last learning objective of this chapter. So we have 4 financial statements. Okay, 4 financial statements. We have income statement, owner's equity statement, statement of financial position, and statement of cash flow. Okay, so always remember that we have 4 financial statements: income statement, owner equity statement, and statement of financial position, and statement of cash flows. Okay, 4. So what is the income statement? Go to the first one. Okay, income statement will show how much revenue and expenses and net income and net loss that you have during a period of time. Okay, and net income normally will result when your revenue exceeds the expenses. Okay, when you have more revenue than expenses, you will have a net income. If your revenue is less than expenses, we will have a net loss. Okay, again, when your revenues less than expenses, then you will have a net loss. Okay. Now this is how the income statement look like. Okay, income statement look like. So we have revenues 4,700 is include service revenue expenses. We have to list down all the expenses, okay? So when you do exercises, don't put expenses and then total all of them, okay? You will get minus point. You need to list down all the expenses, okay? So we have salary and wages expense, brand expense, advertising expense, utility expense, and total expenses. And so revenue minus expenses, we're going to have net income, all right? We're going to have net income of 2,750. Remember for me that you always need to write the name of the statement, which is income statement, and you need to write the name of the companies and the date that this income statement is made. And then after we prepare the income statement, we then prepare the owner's equity statement, okay? Remember, owner equity is influenced by 4 things: owner capital, net income, drawing, okay? Remember that? So owner's capital at the beginning, you know, we have 0. When the owner invests 15,000, we're going to add investment 15,000 and add net income, okay? Where did we get this net income? It's from the income statement. Remember that? Okay, remember that? Income statement shows the net income. What is the net income? Actually, net income is, it shows the revenue minus expenses, right? So remember, owner equity is influenced by revenue and expenses. So when we have revenue and expenses, we will have net income. And so with less drawing, that will give us owner capital at the end, all right, at the end. So remember this format, all right? Always remember this format. Beginning capital, add investment, add net income, minus drawings, and that will give you owner's capital at the end, okay, at the end. Okay, after we get the owner's capital at the end, okay, then we need to prepare the statement of financial position. Now, the statement of financial position is also called the balance sheet, okay? It's called a balance sheet. Statement of financial position also have another names, balance sheet. So balance sheet is show the equality of assets and owner, equity, and liabilities. Erase this. So under assets, you have to list all the account and the ending balance of all these accounts. All right, 8,050. Where did I get 8,050? This is, you know, at the end here. You remember that? This is 8,050. This is 8,050. Okay, so you're going to get the ending balance of all these accounts and put it in the balance sheet here. Okay. We have cash, account receivable, supply equipment, and total assets, $18,050. Then we have owner's equity and liability. So liability, we have account payable, 1,600, and owner's capital. Now, owner capital here, remember that is always the ending, okay? Owner capital at the end, all right? This is the owner's capital at the end, ending, All right. So how do we get owner capital at the end? This is from the owner equity statement. All right, owner equity statement. So you get owner equity at the end, 16,450. And so the total assets will always equal to total liability plus owner equity. Okay. All right, let's go to the last statement, the last financial statement, which is this is called the statement of cash flows. Okay, so the statement of cash flow is which shows how much cash go in and out in the companies. So on the statement of cash flows, there will be three activities: operating activity, okay, investing activity, and financing activity. Okay, it will show the cash flow from operating, investing, and financing. So cash flow from operating is being the cash flow when you running your business. So mostly it will be the cash received from revenue and the cash payment from expenses. Okay, don't worry about the statement of cash flow too much because we're going to learn more about that in chapter 17. Okay, and cash flow from investing activity is it's about buying or selling all the fixed assets. Fixed assets mean like equipment, machine, building, or something like that. Okay, so cash flow from investing activity is the money that you spend or you receive when you buy or sells equipment, machine, building, land, or something like that. We call it cash flow from investing activities. Cash flow from financing activity, it includes what? The investment from the owner. If the owner withdraw the money, we will minus here, and then we will have the net cash from financing activities. Okay, so net cash from financing activity, 13,700. And then we add from operating, we add the cash from operating. Okay, add the cash from investing, and add the cash from financing, and that will give you the net increase in cash. Okay, net increase in cash will be 8,050. And our cash at the beginning, this company doesn't have any cash because it's just established. So the cash will be zero. So during the month, we have an increase of 8,050 cash plus zero at the beginning. So the cash at the end will be 8,050. This is exactly the same as what we have on the statement of financial position. You see that should be the same. Okay, 8,050. Okay, so don't worry too much about the statement of cash flow because we're going to learn more about that in chapter 17 when we study accounting principle 2. So remember again, income statement is show the revenue and expenses for a period of time. Okay, a period of time is means it will be from a special day until another day. For example, it is from January 1 to December 31, 2020. This is called a period, okay, of time, okay, or from January 1 to June 30. Okay, this is called a period of time. Okay, So it is in the income statement, it shows a period of time, okay? It shows the revenue and expenses in a period of time. You always need to list the revenue first and then all the expenses. Don't forget to list all the expenses, okay? Don't just get the total only. List all the revenue and the expenses, you know, like specifically, and then show the net income or net loss. Okay, we have net income when revenues are more than expenses, and we have net loss when revenues are less than expenses. Don't include investment and withdrawal transaction between the owner and business in measuring the net income. Remember, when measuring the net income, is only include revenue and expenses. So don't include any investment or withdrawal. Okay. For owner equity statement is show the changes. Okay, show the changes of owner equity for a specified or for a specific period of time. Okay, again, specific period of time is like, you know, a period from January 1 to June 30, or from January 1 to March 31. So it is a period of time. Okay, it shows how the owner's equity change. All right, for a period of time. All right, it's same as the income statement. Okay, the time period would be the same at the income statement. So what does it include in owner equity statement again? You remember, we have owner equity at the beginning, at investment, at net income, minus drawing. Remember that? Owner capital at the beginning, at investment, at net income, minus drawings, and it will give you owner capital at the end. Okay, at the end of the month or the period. Now, let's look at the statement of financial position. So for the statement of financial position, remember that it has another name called balance sheet, and it reports assets, liability, and owner equity at a specific date. Okay, this is at the specific day. It means only one day. For example, if you want to see the balance of the assets, liability, and owner equity at December, okay, at December 31, 2020. All right. So the statement of financial position is just showing how much is assets, liability, owner equity at a specific date. It doesn't show, you know, for a period like income statement or owner equity statement. Okay, so we call it, it's like a snapshot, of the company financial condition at a specific moment in time. Okay, and remember that total assets always must equal to total liabilities plus owner equity. You need to list the assets at the top and followed by liabilities or owner equity. Okay, and then the next one you have would be the statement of cash flow. So a statement of cash flow also show the cash receipt and cash payment for a specific period of time. Okay, it shows how your cash changes during a period of time. So it will answer the question, where did your cash come from? It's come from the revenue from the customer. What was cash used for? So did you spend your money on buying equipment or, you know, paying for expenses? And what was changed in cash balance? So the statement of cash flows will show you how your cash change during a period of time. All right, so let's try with this question. Which of the financial statement is prepared as a specific day? Which one? A, statement of financial position. B, income statement or owner equity statement or statement of cash flows. Which one is prepared as of a specific date? The answer will be statement of financial position. Okay, statement of financial position. Now let's try with this example. Presented below is selected information related to Lee Fashion at December 31, 2020. Lee reports financial information monthly. So we have equipment, cash, service revenue, rent expense, account payable, utility expense, account receivable, salaries and wages expense, note payable, and owner's drawings. Okay. Then the question say, determine the total assets at December 31, 2020. And question B, we need to compute the net income for December 2020. And C, we need to determine the owner's equity at December 31, 2020. Okay, so let's do it. So first of all, we need to determine the total assets at December 31, 2020. So we need to pick out, okay, the one that belong to assets, okay? So first we have what? Equipment, this is an asset. Cash is an asset, okay? So is there anything else? No, right? So our total assets will be cash 8,000, account receivable. Oh, here, account receivable. Sorry, I can't see it. Account receivable 9,000. Okay, and equipment 10,000. So total we will have 27,000 total assets. And then question B, calculate the net income. So when we calculate the net income, we're going to take total revenue. Remember that? So we will add all the revenues minus all the expenses. That will give us net income. So we have grant revenue, right? Service revenue, 36,000 minus rent expense, utility expense, salary and wages expense, okay? And that will give us the net income. Do we minus drawings? No, okay? Only take revenue minus expenses, and that will give you the net income. So the revenue is 36,000 minus rent expense, minus utility expense, and salary and wages expense, that will give you net income of 14,000. Okay, now question C say, question C, we need to determine owner equity at December 31, 2020. So how do we determine owner equity? Okay, owner equity will be influenced by drawings and also the net income. So what we do is we take assets, okay, minus all the liabilities. Okay, this one, I'm sorry, it should be not payable, not payable expenses. Okay, so this one should be not payable. Let me correct that. Okay, the answer should be not payable. okay? Not payable, not payable expense. Maybe I will cross this down, okay? No, not this one. So we have assets minus liability, and that will give us owner equity. Or another way you can do is take the owner equity at the beginning at net income and minus drawing, and that will give you the owner's equity at the end, okay? But in this question, they didn't say how much is the owner equity at the beginning. Okay? Because this question doesn't say how much owner equity beginning, so we just take assets minus liability, and that will give us owner equity at the end. Okay, now let's look at the career opportunity in accounting. So if you study accounting, you can work in public accounting, and the career will be auditing. It means you can be an auditor, a tax expert, or management consulting services, or you can work in private accounting company as managerial accountant, cost accounting. You can do budgeting or designing accounting information system, taxation, or you can work in governmental accounting where you work in tax authorities to collect tax or from other companies, law enforcement agency, company regulators, public colleges and university, or in local government. Or you can work in forensic accounting where we use accounting, auditing, and investigative skills to conduct investigation into theft and fraud. Okay, so in forensic accounting, we're going to use accounting, auditing, or other skills, to investigate if others they commit fraud, they steal the assets or something like that. So we could career, so forensic accounting. Okay, so that is all for this chapter. I hope you understand it. And if you have questions, you can ask me in the class. All right, thank you so much, everyone. Bye-bye.